Classification and disclosure of equity and borrowing instruments. Equity and borrowings classification. To wrap up the technical classifications under Schedule 3, we look at how IND AS differentiates between what an entity owns versus what it owes, focusing on the substance of the contract rather than its legal form. Equity share capital. The principle, under IND AS, equity is defined by the contract's substance. If a contract evidences a residual interest in the entity's assets after deducting all liabilities, it is equity. Convertible instruments. Instruments like convertible preference shares or debentures are classified as instruments entirely equity in nature if they meet the IND AS 32 definition and contain no liability component. Borrowings and term loans. Definition: term loans are not strictly defined but are characterized by a fixed or predetermined maturity and repayment schedule. Current maturities. A critical rule for your financial statements is that any portion of a long-term, non-current, borrowing due for payment within 12 months of the reporting date must be reclassified to current borrowings. Demand loans. Any loan payable on demand is automatically treated as a current borrowing. Default disclosures. If an entity is in default on its current borrowings, it must disclose the period and the amount of the default item-wise as of the balance sheet date. Actionable next step. Does the reclassification of long-term debt into current borrowings based on the 12-month window make sense? We can next cover the final Chapter 1 nuances regarding statutory dues and exceptional items, or move into the conceptual framework for Chapter 2. End of Episode 12. Drink, eat, or revise.